Family, what's good? Welcome to Doctor's Financial. If you're stopping by the channel for the first time, my name is Dr. V. As we can see, the markets were red today. Everything, all of the indices were down. Even the VIX was down. Usually the VIX is inverse to the markets, but we can see that the VIX was also down today. Never fear. Days like today are days that we look to buy. I did buy 3 stocks. I want to show them really quick before I get into the stocks 104 on the stocks 100 series. We're going to be going over, and it's a good time to go over stock 104, especially after a day like we had on today. Really quick, let's look at some of the things I picked up today. I picked up some Square. I got Square at around 150 at around 252. And let me show you the reason why really quick. Coming from here, we can see where I bought it was almost a 10% discount from the 1 month. So I believe for me that was a great time to dollar cost average in. Great dip buy for me in a company that I like, which is Square. I also bought some Nike today. Ticker symbol NKE. Take a quick look at Nike, and look, even after I was already up, I got me some Nike at 160, so that was great to pick it up at 160. And we can see, just quickly going over let's go here, it's easier to click. Nike was almost close to 10% down, so good time for me to pick up some Nike. And the other dip buy that I picked up today was a new stock for me that I've been wanting to get into ever since it had a nice little pullback back in August, the 1st of September. Back in August, 1st of September, had that nice little pullback, almost 10%. I've been trying to get in, and been missing it. And that's Abbv. So that's 3 stocks. If you want to keep track of what I've been looking at and buying, that's 3 stocks to really go in, do your due diligence, do your research. Square and Nike I've talked about before. Abbv I haven't talked about before. No, I've talked about Abbv before on the channel also. I did talk about Abbv, and I finally was able to go ahead and get in. So go ahead, do your due diligence. Look into these companies. Nike and Abbv pay a dividend. Square is a nice growth stock that should do well in the future. Alrighty, that's what I've been doing on a red day like this. Family, use these red days to go ahead and buy. We can see the futures are down also, and the S&P has been a 3-day losing streak, so we should be seeing some green soon, hopefully in the S&P. Alright, now let's get into investing. Let's get into stocks 104 in the stock 100 series. Let's go ahead. Stocks, what matters and what doesn't. The frenzied days of Wall Street traders aside, stock investing involves a lot of careful thought. Here is a short look at what matters, and it's important that we know what matters and what really doesn't. Let me close this. Alright. What we're going to learn: investing does not equal trading. Very important. Investing means owning a business. We talked about this before. Very important we understand that. And competitive positioning is most important. And we're not talking about competitive positioning as far as what we do in our portfolio, although that is important. What we want is competitive positioning of the companies that we buy. And it's I want you guys to go ahead and look up some of the companies when you're looking at competitive positioning. Some of the companies that are going throughout the world that are going through antitrust, any type of antitrust litigation. Those are companies you want to take a look at, and companies I'm not your financial advisor, but companies that I like to hold. And the reason I say that is because we have a saying when we're playing cards: if you're not cheating, you ain't trying. And I don't want to say that these companies are cheating or these companies are doing anything unscrupulous. However, when you are looking at some antitrust litigation in a company, more times than not, that company has either a monopoly or at the very least a pseudo monopoly over whatever industry that they're in. And that's what you want in a company. You want a company like Apple, who's always in some type of litigation, people saying that they're too big or too powerful and they're doing this to me, they're doing that to me, we can't compete. Same thing with Amazon. You want to own those type of companies because those are the companies that year over year continue to make money. They have a stranglehold over the industry that they're in. Alrighty, now, investing does not equal trading. Your perception of stock investing may involve highly caffeinated, frantic traders sweating in front of half-dozen computer screens packed with information, phones ringing off the hook in the background. And we all see the scenes on the TV shows and everything, the movies where you got people running back and forth, back and forth, back and forth. But that's not investing. That's not what we should be doing. Those are traders. And the same thing with day traders. Those aren't what we should be doing, especially new investors. Actively day trading is not how most good investing is done by individuals. That perception is wrong. Feel free to dump these images from your mind because solid stock investing is not about trading, having the fastest computer, or getting the most up to the second information. Though some professionals make their living by creating a liquid market for stocks, i.e. actively day trading, it is simply not how most good investing is done by individuals such as you and me. Beyond having to expend an incredible amount of effort to track the stocks on an hour by hour basis, and some of those day traders I'm talking about, they're going minute by minute. Active day traders have three powerful factors working against them. First, the trading commissions. Now, this is a little bit older, so many of the day traders don't have to face the trading commissions anymore. This was written before everybody started having the free trades. Second, there's the second thing that's working against them are other trading costs in terms of the bid-ask spread. Go ahead and look that up. And the third thing that's working against them is taxes. Finally, frequent traders tend not to be tax efficient because of all of the money that they're making, and it's all short-term income. You are going to be paying a little bit more taxes. With that aside, there are some day traders that do well. I do not actively day trade. If something happens to move incredibly well in my direction that I have just purchased, then I will make a day trade. I have done it on occasion, but I do not actively seek to make a day trade. Making the right moves is more important. Just as someone can be a great race car driver without being a mechanical engineer, you can be a great investor without having a clue how the trades actually get executed in the market. And that's probably true for most of us. Most of us don't really understand order flow and payment for order flow and all of those things that go on. And some of the reasons why, as users of Robinhood, we don't and how Robinhood gets paid by using payment for order flow. A lot of us don't really understand that. And you don't really have to understand that too much to do well with investing. All right, now here's the first question. To be a successful stock investor, you need to be able to think quickly with fast reflexes. That's the first answer. A powerful computer with up-to-the-minute information, patience, and the ability to think about future trends. Of course, we know the third is the answer. We need patience and the ability to think about future trends, with, in my opinion, patience being the most important. But definitely looking at the future and looking at what's going to be needed, what's going to be, where's the world going, what is the world moving to. Very important we start understanding that. That's some of the reasons why I got into a lot of the space companies. And correct. Let's go into the next one. Investing means owning businesses. If the mechanics of actual trading mean little, what does matter? Do charts of stock prices hold the answers? We've said it once and we'll say it again and again. when you buy stocks, you are buying ownership interest in companies. Stocks are just pieces of paper to be traded. Stocks are not just pieces of paper to be traded. Remember, when we buy a stock, since Stocks 101, even when I had my 5-year-old daughter with me, we know that stocks is ownership of a company, and we want to own great companies. Use research and care when buying stocks. If you pick the right stocks, you can make money no matter what the broader market does. Think like a business owner. So if you are buying businesses, it makes sense to think like a business owner. This means learning how to read financial statements. Very important, we learn the fundamentals. We learn at least the very basics of PE ratio, some of the quick ratio, cash flow, how to read a balance sheet. We need to know that the companies that we're getting into, the companies that we're buying, are viable, profitable companies that will be so for years to come. That's what we want to invest in. And notice I didn't say trade or swing trade, but invest in. Considering how companies actually make money, spotting trends, and figuring out which businesses have the best competitive positions. Think Apple, think Nike, think Home Depot. They are industry leaders. They are the best at what they do. Think Amazon, think Google, think Facebook. It also means coming up with appropriate prices to pay for the businesses you want to buy. Notice that none of this requires lightning fast reflexes. Yeah, so you want to be able to research this stuff out. And you want to begin doing your research early and then find out the price that you think the company should be and then set your prices there. And when the company falls back down to that price, it's a good time to buy. Now, I do use a technical analysis to help me find some good prices. But when you're looking at long-term investing, the fundamentals, in my opinion, are more important. You should also buy stocks like you would any other large purchase, with lots of research, care, and intention to hold as long as makes sense. Some people will spend an entire weekend driving around different stores to save $60 on the television. That's me sometimes. Sometimes when I'm looking to buy purchase a television, a washer dryer set, refrigerator, things like that, I do my due diligence on it. And we should do the same thing when purchasing a stock. We shouldn't just purchase it based on what someone is telling us. We should be doing our own research and find the best prices, just like we would when we purchase, say, a car, or we purchase a home or some property. We do our research. We know what the market for that particular item is. We should be doing the same with the stocks. You buy stocks, not the market. We've all seen the prognosticators on television predicting where the market is going to go in the future. One thing to remember when listening to these market premonitions is that stock investing is about buying individual stocks, not the market as a whole. If you pick the right stocks, you can make money no matter what the broader market is doing. If you're in a great company and you're planning on holding that company for the long term, even through a bear market, the prices may be dropping, but if your company is doing well, either it won't drop as bad as the overall market, or it will even make money during a bear market or during a down market. So that's why it's important to always look at great companies. Be able to identify great companies. And another thing about these let's get into it here. Beware the market predictions. Another reason to heavily discount what the prognosticators say is that correctly predicting market movements in the short term they should have put this, in the short term and even midterm, is nearly impossible. No one has done it consistently and accurately. There have been people that can do it for a year, do it for a couple of years. Back in 2020, when the market was booming, you could have called out any company and they were just running up. I mean, companies that were unproven, companies that were losing money, burning through money, millions of dollars a month, where their stock price was still going up in 2020. Now, many of those companies are 50, 60, 70% down. So it's important that we understand when the market is running up, anybody can give a great prediction. There are simply too many moving parts and too many unknowns to predict the market correctly. By limiting the field to individual businesses of interest, you can focus on what you can actually own while dramatically cutting down on the unknowns. You can save a lot of energy by simply tuning out market predictions. Yeah, if you're listening to what a bunch of different YouTubers, you listen to a bunch of different people on CNBC, CNN Business, Fox Business, you listen to all these different people give you all these different situations, and this may go here and this may go here. If you're long-term investing, all of that stuff is not. You don't have to worry about that stuff. All of that stuff is not as important as they make it seem. All of those short-term movements and trying to predict the market for the short term. Now, stocks are volatile. We got to remember that, especially in the short term. Why is that? Does the value of any given business really change up to 50% year to year? Imagine the chaos if the value of our homes changed this much. If the value of your house costs 50% and then the next month it gained 50% and the next month it lost 30%, we'll be going crazy if the housing market did that. But in the short term, that's just how stocks move. The fact is, Mr. Market tends to be a bit of an extremist in the short term, overreacting to both good and bad news. This is a good fact to know when starting. So you may buy a stock and then the next day some crazy news comes out and you just bought it and then it falls 20%. But if you've done your due diligence, you know the company that you're buying is going to be great 2 years from now, 5 years from now, 10 years from now, 15 years from now. Don't worry and panic on the short-term fluctuations in the market. Alrighty, let's see what question we have next. A stock investor should learn to think most like a 1. Business owner, stock analyst, market prognosticator. So to be a good stock investor, which one do you think? I'm going to give you a little bit of time to think about it. To really do well as investing in the stock market, what do you think you should think like? All right, now I'm going to go ahead and answer it because they already told us business owner. Because the stocks we buy are actually businesses. We're buying businesses, not just numbers and tickers and letters. All right, competitive positioning is most important. A word that a lot of people in the stock market like to use when talking about this with the companies about competitive positioning is a moat. And a moat simply is if any of you all are into that medieval stuff and into castles and kingdoms, what they would do is dig a huge trench, and the only way you can get across it is with a bridge. And if they don't drop that bridge, you can't get in. So think about companies that have a huge trench around it or a huge barrier of entry. So I would always use Apple at the time, but if you think about a company like Apple, it's going to be hard for someone else to come in and take Apple's customers away. It's going to be hard for someone to come in and do what Apple is doing because they have their own operating system. Once you're in Apple, your phone is connected to your computer, is connected to this, is connected to the watch, and everything is just connected. And then they maybe come up with a car, and all your car is going to be connected to the phone, it's going to be connected to your earbuds, it's going to be, everything gets connected. So it's hard for someone to come in and do what Apple is doing. Same thing with Home Depot. It's hard for someone to come in and do what Home Depot does. You have stores that may sell some hardware things, but it's no store that's going to have the lumber. It's going to have, well, Lowe's does also. But besides Lowe's and Home Depot, where can you get your lumber and also get your sheetrock and get everything else and then rent the tools and have all of this other stuff that goes along with building and construction that Home Depot has. And there's so many other companies. When you think about sporting goods, who's going to compete with not sporting goods but sports apparel, who's going to compete with Nike, so on and so forth. You guys know what I mean about competitive positioning. Now, future profits drive stock prices over the long term. So it makes sense to focus on how a business is going to generate those future earnings. Competitive positioning, or the ability of a business to keep competitors at bay, i.e. having a moat, is the most important determining factor of future profits. And as I said earlier, that antitrust litigations that some of these companies are having, they're keeping companies so far at bay that those companies are saying it's not even fair anymore. We have to take them to court. You have government saying it's not even fair anymore the way that they're making money. We got to really go ahead and take a look at this. So go ahead, if you look at some of the companies that are actually going through antitrust litigation, like I said, because they are more than likely have a huge moat and a huge advantage and will be making money for years to come. All right, despite where the financial media may spend most of its energy, competitive positioning is more important than the economic outlook, more important than the near-term flow of news that jostles stock prices, and even more important than management quality at a company. Now that's a big one. The competitive advantage of a company is even more important than the management of that company. And for me to put that into perspective for people that play sports, if I just have the best team, if I have the best player, I don't have to be the best coach if I'm going against a lower quality team. I.e., for anybody who remember when Steve Kerr got hurt, the assistant coach took over for Golden State, he won like 34 games or so. He did so well when Golden State was doing their best. I forgot exactly what the assistant coach's name, but he did extremely well because he had the best players. And then as soon as he went to another team, his team did awful. He could barely win half of the games, and I believe he even lost his job and went to another team. And it was not because he was a good coach or a bad coach. It's just simply because he had the best players. And it's the same thing with it's the same thing in business with these companies. Apple is going to do well. I don't want to say no matter who's at the helm, but as long as you have a competent CEO, it doesn't have to be the best CEO. As long as you have a competent CEO, because of the products and what Apple has, Apple is going to do well. Amazon just changed CEOs. Amazon is still going to continue to do well just because of what Amazon has and the moat, the advantage that Amazon has created. So as long as they have a competent CEO, they're going to do well. Now, I do like certain companies with certain CEOs. So I do think a good company with a great CEO does do better. So I do like a CEO, but we can see that the company and what they do is more important than even the management. So very important with that. All right, compare investing to selling on a ship. This is good. It may be helpful to think of the investing process as if you were planning a trip across the ocean. You cannot do anything about the current weather or the tides, i.e. the current economic conditions. You can try to wait out the bad weather that may sink your ship. But then you're also giving up time. And we've already covered time is a precious resource when investing. Time is really important when investing. The earlier you can get in a good company, the more you're going to make in the long run. The main thing you can control is what ship to board. Think of the seaworthiness of a ship as a competitive positioning of a business, and the horsepower of the engine as its cash flow. Some ships have thick, reinforced metal hulls, while others have rotting wood. Clearly, you would pick the ship that are most seaworthy. You will pick the company with the best competitive positioning. At least we should. And you want to pick the ship that have the most horsepower, the ship that has the most cash flow, best competitive positioning, and the most money. Which companies are best competitively positioned and have the most money? Ask yourself that. And then when I ask myself that, I have to make sure that my portfolio shows this. My portfolio has the vast majority of the companies that are competitively positioned and have the most cash flow. It's okay if you want to play around and have a few, and I'm talking to myself also, and have a few speculative stocks and stocks that aren't profitable yet. But those companies should not make up the bulk of your portfolio. If they do, during times like the market is now, you're going to find yourself being down, and you're going to find yourself panic selling at times and losing money. Though the ship's captain, which is company management, it certainly matters, the quality of the ship is more important. A solid vessel, as long as the captain does not mess up, like I said, as long as you got a competent CEO running those companies, there is not much difference between a good and a great captain. Meanwhile, there is nothing the best skipper can do if the boat's engine is broken. You can be the best boatsman, the best yachtsman in the world. If the engine is broken, or if it's a sailboat, the sails don't work, the boat ain't gonna do what it's supposed to do. I don't care how good you are. To relate this to stocks, business economics trump management skill. A better ship is always best. It is also worth noting that all ships will experience some waves or volatility. All companies are going to experience that up and down. Even Apple, Home Depot, Nike, Amazon, Google, all companies, Microsoft, all companies are going to experience that up and down. And though it is true that a rising tide lifts all ship, the tides have nothing to do with the quality of the boats on the sea. The market has nothing to do with the quality of the companies we invest in. All else equal, a better ship is still going to arrive faster. And a company with the best competitive positioning is going to create the most value for its shareholders. Let's see this question. As a stock investor, what should you pay the most attention to? Charts of stock prices, a company's competitive positioning, the predicted movement of the overall stock market. So we just read about competitive positioning. We know competitive positioning is the answer for that one, and that's correct. Let's continue. Summary of stocks. What matters and what doesn't. It is very easy for new stock investors to get started on the wrong track by focusing only on the mechanics of trading or the overall direction of the market. To get yourself in a proper mindset, tune out the noise and focus on studying individual businesses and their ability to create future profits. As you learn more about stocks, you will begin to build the skills you need to become a successful buyer of businesses. So what we learned in Stocks 104 is about getting into businesses with competitive positioning. When I first began the channel, I said for new investors, in my opinion, it's best to get into an index fund or an ETF that follows a particular sector. But definitely, I would say an index fund. And then once you begin learning the companies that are in that index fund, understanding what companies do best and what companies have that competitive advantage. This is so important. Stocks 104, this is a very, very important lesson. It's going to tune us out of always looking for the next penny stock that's going to pop and loading up our portfolios with those kind of stocks. And then we just get destroyed during times like these while the stock market continues to make new highs because of these companies with the competitive advantages, but you are not seeing your portfolio grow. Oftentimes when I'm doing my one-on-one coaching sessions, I see this, and it's so hard to, I don't want to say it's so hard, but one of the things that I do try to convey the most is get out of the mindset that you gotta hit a home run with each and every stock that you buy, and understand you want to buy companies that have proven themselves and have done well year in, year out, year in, year out. And then You want to get and find those companies at the lowest price that you can get them at. That's my philosophy. That's the thing I do best. That's what has gotten me the most gains in my portfolio. Finding great companies when they're down, buy them, continue the dollar cost average, and just ride the wave up for years to come. All right, let's go ahead and take the quiz. Investors who trade frequently, on average, end up with higher tax burdens to pay as opposed to not trading often. And that's a true or false question. I put true. Sorry for not giving you guys time to answer, but I put true. What will drive the price of a company stock the most over the long term? Is it economic conditions over the next year? Future profits and cash flow a company can generate? The education level of top management? I'll give you a second to think about that and then answer it. I'm going to put future profits and cash flow a company can generate. A stock investor should learn to think most like, we already answered that question and went over it, but we'll go over it really quick. Business owner, a stock analyst, or market prognosticator. In general, the more frequently you trade, the higher your expected return from a stock investing, the less you will pay in total trading commissions, the higher your tax bill. We already learned that. And this is the last question. Investors have loads of tools at their disposal for analyzing the markets. Therefore, is it correct to say that we can consistently and accurately predict market movements? We still cannot consistently and accurately predict market movements. The market is impossible to predict. Well, we don't want to say the market is impossible to predict, because there are times where people do predict it and get it right. And if you just say over the next 10, 15, 20 years, the market will go up, more than likely, very much more than likely, you're going to be right. Because we already read over the last, over any 10-year span, the stock market has done better than any other investment vehicle. But to answer this question is, we still cannot consistently and accurately predict market movements. No matter how many tools you have, just no way to consistently and accurately predict. If you could do this on a consistent basis, you'll easily be a billionaire. Alrighty, let's go ahead and submit. 100%, got them all right. Family, I want to thank you all for rocking with me through another video. If you haven't already, go ahead, hit that like button for me, subscribe to the channel, comment. I want to hear what you have to say, what you guys think about this. Comment down below, but most of all, share this with others, especially those who do not invest, especially those who are thinking about investing but don't know where to get started. Let them go ahead and check out a couple of videos, especially the videos in the Stock 100 series, to go ahead and get a better understanding of how we should be investing and what companies we should be buying. Okay, family, I'm going ahead and end this video with a prayer, and if you would like, you can go ahead and pray with me. Gracious Heavenly Father, thank you so much for all you have done. Thank you for blessing us with the ability, the opportunity, and the resources to learn more about investing. Please help us to do well with all of our investments. Bless us, Lord God, so that we can be a blessing to others, Heavenly Father. Lord God, continue to bless our families. Bless us for generations to come with financial freedom and financial independence. May our cups runneth over. In Jesus' name I pray. Amen. Family, be blessed.